We are now entering the final countdown. I want you to look at the date on your screen. It is Wednesday, December 31st, 2025. We are exactly 36 hours away from the moment the world changes. In 36 hours, the sun will rise on January 2nd. The holidays will be over, and the China export ban will become active law. But we do not have to wait for Thursday to see the damage. The damage is already here. For the last 48 hours, we have been warning you about a bifurcation, a splitting of the market. Well, today, that split became a fracture, and that fracture just became a chasm. Ladies and gentlemen, Asian guy here, known as John A.G. from Currency Archive. As I speak to you right now, there is no longer a single price of silver. The global market has shattered into three distinct realities. And if you're looking at the price on your banking app or your standard news terminal, you're looking at the wrong reality. You're looking at a ghost. Let's look at the three-tier market that has emerged this afternoon. Tier 1 is the panic price. This is the price in Shanghai. The Shanghai Futures Exchange closed its final session of the year at an equivalent of $84.55. This is the price being paid by the manufacturing capital of the world. This is the price being paid by the entities that actually consume the metal. They are desperate. They are front-running the ban. And they are paying whatever it takes to secure inventory before the doors lock in 36 hours. Tier 2 is the physical price. This is the price in the Middle East, specifically in the UAE and Dubai physical souks. We have confirmed live transaction prices averaging $79.61. This is the honest physical market. It is not in a total panic like China, but it is tight. It is demanding a premium. It is telling us that even outside of the export ban zone, physical silver is trading nearly $8 higher than the paper spot price. And then we have Tier 3. Tier 3 is the zombie price. This is the COMEX spot price in New York. It is currently trading at $72.15. Do the math with me. $84.55 in Shanghai, $72.15 in New York. That is a spread of $12.40. That is a 17.2% premium. I want you to understand how impossible that number is. In a functioning global economy, a spread of 17% on a fungible commodity like silver is illegal by the laws of physics. Arbitrage traders, the banks, the hedge funds, exist to close that gap. If they could, they would buy every single ounce in New York at $72 and sell it in Shanghai at $84. They would make risk-free billions, but they aren't doing it. The gap isn't closing. In fact, it widened from $5 yesterday to $12.40 today. Why? Because the arbitrage is dead. The traders know that they cannot move the metal. They know that the January 2nd deadline is a hard wall. They know that if they buy silver in New York today, they cannot physically ship it, clear customs, and land it in Shanghai before the licenses go active in 36 hours. The bridge has been burned. New York is an island of paper trading, stranded in a sea of physical shortage. So when you see $72.15 on your screen, realize that it is a lie. It is the price of a paper contract that nobody wants. The real world, the world of factories, solar panels, and strategic reserves, is trading at $84.55. That is the real price. The fact that the paper market is lagging by $12 tells you that the COMEX has lost control. It is no longer the price setter. It is the price suppressor. And the physical market has finally decided to ignore it completely. But the spread is only the symptom. The disease is much, much worse. Because while the price is broken, the volume is exploding. We just got the delivery data for today's session, and it confirms our worst fears. Yesterday, we saw a vacuum operation in China. Today, we are seeing a run on the bank in New York. The delivery volume hasn't just gone up, it has gone vertical. We are talking about a 26 times increase in physical demands in a single day. Let's look at the delivery spike that is draining the COMEX dry. Do you remember yesterday? In our last alert, we mocked the COMEX volume. We pointed out that out of billions of paper ounces traded, only 69 contracts stood for delivery. That is a paltry 345,000 ounces. It was a joke. It was evidence that the market was purely speculative. But today, the joke is over. We just received the preliminary delivery notices for the December 31st session. The number of contracts standing for physical delivery has exploded to 1,847. Let's do the math on that. 1,847 contracts times 5,000 ounces per contract equals 9,235,000 ounces. 9.2 million ounces demanded in a single day. Compare that to yesterday. 345,000 versus 9,200,000. That is a 26 times increase in physical demand in just 24 hours. This is not a pickup in volume. This is a raid. This is a panic event. It means that nearly 2,000 large entities, banks, funds, industrial giants, looked at the calendar, saw January 2nd approaching, and hit the deliver button simultaneously. They are no longer content to roll their contracts forward. They are no longer content to hold paper exposure. They want the bars. They are effectively cashing out their chips before the casino closes for the night. Why? Because they know what happens in 36 hours. They know that once the China export ban goes live, the global supply chain freezes. They know that the $12 premium in Shanghai is going to act like a black hole, sucking up every available ounce of silver on the planet. So they are raiding the COMEX vaults, while the price is still suppressed at $72. Think about the arbitrage from their perspective. They can use their paper contracts to demand delivery at $72.15. If they can get that metal out of the vault, they instantly own an asset that is trading at $84.55 in the real world. They are buying dollars for 85 cents. It is the trade of a lifetime, but only if you can get the metal now. This 26-fold spike in delivery demands is the system trying to correct itself violently. It is the sound of the paper shorts getting trampled. Imagine being a bullion bank that sold those 1,847 contracts. You thought you were just hedging. You thought the buyer would roll the contract next month like they always do. And suddenly, today, they demand the metal. You have to find 9.2 million ounces of physical silver today. Where are you going to get it? Shanghai is closed to you. The premiums in the UAE are nearly $8 over spot. You are trapped. This delivery spike is the mechanism that breaks the bank. When you force a paper market to deliver physical assets at a 26 times normal rate, you drain the liquidity instantly. And that explains exactly why the banking system is screaming for cash. That explains why the Federal Reserve had to intervene again today. Because the banks aren't just losing money on the spread, they are bleeding cash trying to settle these physical deliveries. If yesterday's $3 billion injection was a warning shot, today's injection is a confirmational signal that the bleeding hasn't stopped. In fact, it is getting worse. We have uncovered another massive liquidity operation that happened quietly while everyone was watching the New Year's Eve countdown. Let's look at the $5.8 billion secret bailout that is keeping the system afloat right now. Let's look at the Fed. And what we see when we look at the Federal Reserve's balance sheet this afternoon is terrifying. You might have assumed that the $3 billion injection yesterday was a one-time event, a singular band-aid for a singular problem, but the data from this morning proves that the wound is not healing. It is hemorrhaging. We have just confirmed that the Fed executed a second emergency repo operation today, December 31st. The amount was $2.8 billion. When you add that to yesterday's $3 billion, we are looking at a total of $5.8 billion of emergency liquidity injected into the banking plumbing in just 48 hours. $5.8 billion. To put that into perspective, that is more than the entire market capitalization of most mid-tier mining companies. It is enough cash to buy nearly 80 million ounces of silver at current prices. And the banks burned through it in 2 days just to stay solvent. Why? Why do the banks need nearly $6 billion of overnight cash right now? Because of that delivery spike we just discussed. You have to understand the mechanics of a short squeeze on the bullion banks. When those 1,847 contracts stood for delivery today, the banks on the other side of the trade, likely JP Morgan, Citibank, and Bank of America, were caught in a liquidity death spiral. They are short paper, but they owe physical. To fulfill those deliveries, they have two choices. Choice A, they deliver the metal they have in their own vaults, but their vaults are running low and they are terrified of emptying them completely before the China ban starts. Choice B, they have to go into the open market and buy the metal immediately to hand it over to the client. But here is the problem. The open market is broken. If they try to buy silver in Shanghai, they have to pay $84. If they try to buy it in the UAE, they have to pay $79, but they sold the contract at $72. They are locking in a massive loss on every single ounce they deliver. They are buying high and delivering low. This destroys their cash reserves. It burns a hole in their balance sheet instantly, so they have to run to the Fed's repo window to borrow the cash to cover the spread and to finance the settlement. The $5.8 billion is effectively the cost of the spread. It is the price the Western banking system is paying to keep the game going for another 24 hours. And we are seeing the stress fractures appear in the individual bank reports. We are hearing whispers from the trading desks that JP Morgan has quietly increased its loan loss provisions for its commodities division by $400 million overnight. You don't provision $400 million for a rainy day. You provision it because you know a storm is hitting your portfolio right now. They are bracing for impact. They know that the silver positions they hold are toxic. We are also seeing reports from Citibank insiders that unprecedented physical delivery requests are clogging their settlement systems. They are delaying. They are stalling. We have heard stories of clients asking for their metal and being told it will take administrative time to process. Administrative time is banker code for we don't have the silver and we are scrambling to find it. Bank of America is reportedly extending its delivery timelines from the standard 2 days to nearly 2 weeks for large orders. Why the delay? Because they are trying to source the metal from London or from ETFs or anywhere they can find it, because they don't have it in New York. This is a classic bank run dynamic, but instead of people lining up at the ATM to pull out $20 bills, it is industrial giants lining up at the COMEX to pull out 1,000-ounce bars. And the banks are insolvent in metal. They have the dollars because the Fed just gave them 5.8 billion of them, but dollars cannot print silver. This is the fatal flaw in their suppression scheme. They thought they could control the price forever with paper leverage, but leverage works both ways. When the lever snaps back, it crushes the person holding it. And think about the timing of this liquidity drain. It is New Year's Eve. Usually the repo markets are quiet. Banks want to close their books and go home. For the Fed to be this active and for the banks to be this desperate for cash on December 31st tells you that the panic is acute. They cannot wait until January 2nd. They need the money now. This $5.8 billion bailout is the invisible evidence of the crash. The price on your screen says $72, so you think everything is calm. But the balance sheet of the Federal Reserve says $5.8 billion, which tells you the building is on fire. They are using the money hose to spray down the flames so that the retail public doesn't see the smoke. But the smoke is there. You just have to know where to look. And while the banks are burning cash in New York, trying to patch the holes in their delivery obligations, the situation in Shanghai has accelerated from a vacuum operation to a total depletion event. If you thought the 41 tons we talked about yesterday was a lot, wait until you see the updated numbers from the Shanghai vaults today. The speed of the drain has doubled. The Chinese aren't just taking metal, they are gutting the exchange. We need to talk about the 84-ton aggregate withdrawal that has brought the Shanghai inventory to critical levels. We need to talk about the math of depletion, because at this rate, there won't be any silver left to fight over by February. Let's look at the vault data. And while the banks in New York are desperately trying to plug the holes in their balance sheets with paper dollars, the vaults in Shanghai are being emptied of physical reality at a speed that defies historical precedent. We talked about the 41 tons that vanished yesterday, and many of you thought that was a one-off event, a singular strategic move, but the data from the Shanghai Gold Exchange Clearing Report this morning proves that it wasn't a one-off. It was just the first wave. We have now confirmed that an additional 43 tons of silver were withdrawn during the December 31st session. When you add that to yesterday's 41 tons, we are looking at a total of 84 metric tons of silver removed from the exchange in just 48 hours. Let's translate that into ounces, because the sheer weight of this move is hard to comprehend. 84 tons is roughly 2,700,000 troy ounces. Gone. Removed from the registered stockpile, loaded onto armored convoys, and driven into the dark. To put this burn rate into perspective, the Shanghai Exchange typically sees withdrawals of maybe 2 or 3 tons a day during normal trading. We are currently seeing withdrawals of 42 tons per day. That is a 1,400% increase in physical offtake. This is not industrial consumption. Factories do not suddenly need 14 times more metal overnight to build solar panels. This is panic hoarding. This is the smart money in China looking at the clock, seeing 36 hours left until the January 2nd export ban, and deciding to drain the swamp completely. And the impact on the total inventory is catastrophic. We have been tracking the Shanghai inventory levels for years. 2 days ago, we were worried because the level had dropped to 755 tons. Today, the official inventory count has crashed to 727 tons. Think about the math of that trajectory. They are draining roughly 3.5% of the entire exchange's inventory every single day. If this rate continues, and there is no reason to believe it will stop, the Shanghai Gold Exchange will be mathematically empty in less than a month. Zero. No metal left. But it won't take a month, because markets don't go to zero in a straight line. They snap. When the inventory drops below a certain psychological threshold, usually around 500 tons, the panic accelerates. The buyers realize that there isn't enough for everyone, so they double their orders. The run on the vault goes exponential. We are watching the beginning of that exponential curve right now. You have to ask yourself, who is taking this metal? It isn't the retail guy buying a few coins. You don't withdraw 84 tons in coin form. This is the state. This is the strategic reserve. This is the battery conglomerates like CATL and BYD. These are entities that have inside information. They know exactly how strict the new export licenses are going to be on Thursday, and their actions are screaming at us. By withdrawing 84 tons in 2 days, they are telling us that they expect the supply chain to freeze completely. They are engaging in preemptive logistical capture. They are securing the atoms before the politicians secure the borders. And this creates a terrifying feedback loop for the West. Every ounce that leaves the Shanghai vault is an ounce that can never be arbitraged back to London or New York. It is an ounce that is permanently removed from the global float. The Western banks, the ones we just discussed who are short millions of ounces, are watching this inventory drop and sweating bullets. They were counting on that metal. They were hoping that maybe, just maybe, China would export some silver to cool down the global price. But China is doing the exact opposite. They are locking it down. This 84-ton vacuum is the physical manifestation of the price split we talked about in part 1. Why is silver $84 in Shanghai? Because there are only 727 tons left, and everyone wants them. Why is silver $72 in New York? Because nobody believes the COMEX has the metal anyway, so the price is just a paper fiction. We are watching an inventory crisis unfold in real time. 84 tons in 48 hours. That is the statistic that matters, not the RSI, not the MACD, the physical drain. Because you can print money to bail out a bank, but you cannot print 84 tons of silver to refill a vault. And this hoarding isn't just happening at the exchange level, it is trickling down to the corporate level. The panic has spread from the state vaults to the factory floors. We are seeing major industrial players, companies you know, companies that are household names, start to panic buy. They are realizing that their just-in-time supply chains are about to become not in time. We have reports involving Samsung and Tesla that confirm the industrial panic is no longer a theory. It is a boardroom reality. Let's look at the corporate panic that is driving the next wave of demand. Let's look at the industry. And this hoarding isn't just happening in the dark corridors of the Shanghai Gold Exchange or the confidential ledgers of the Federal Reserve. The panic has trickled down from the geopolitical level to the boardroom level. It has infected the real economy. We have to talk about the industrial giants. For the last 20 years, the entire global manufacturing system has run on a philosophy called just-in-time. It is a beautiful system when it works. You don't hold inventory. You don't pay for storage. You order exactly what you need for this week's production, and the truck arrives at the loading dock exactly when the assembly line needs it. It is efficient. It maximizes cash flow. But just-in-time has a fatal flaw. It relies on the assumption that you can always get what you need at the price you expect whenever you pick up the phone. Today, that assumption died. Today, the biggest companies in the world realize that just-in-time is about to become not in time. And if they don't secure the metal now, their factories go dark in February. We have received credible reports from inside the Asian supply chain regarding Samsung. Samsung is not just a phone company. They are one of the largest consumers of silver for electronics and high-tech batteries in the world. According to supply chain sources, Samsung has just executed emergency procurement orders to secure 6 months of silver supply in advance. Think about the magnitude of that shift. Usually, a company like Samsung holds maybe 2 weeks of inventory. Overnight, they have decided to hold 26 weeks. They are effectively taking half a year's worth of demand off the market today. Why? Because they see the same data we see. They see the 84-ton drain in Shanghai, they see the export ban coming on Thursday, and they know that without silver, they cannot make a single circuit board. They cannot make a single screen. For Samsung, paying a $5 premium or even a $10 premium is irrelevant. The cost of silver is a fraction of the cost of the phone, but the cost of zero silver is bankruptcy. So they are panic buying, they are hoarding, and they are not alone. We have seen internal memos circulating from Tesla's procurement division, specifically related to their solar roof and EV battery segments, labeling their current silver inventory levels as critical. The memo reportedly authorizes purchasing managers to pay above spot to secure immediate physical delivery. This is the smoking gun. When Tesla tells its buyers to ignore the spot price and just get the metal, the spot price becomes meaningless. Tesla is bidding against Samsung. Samsung is bidding against Apple. Apple is bidding against the Chinese solar giants. And they are all fighting for the same shrinking pie. And let's talk about those Chinese solar giants. We know that China controls 80% of the world's solar panel production. We know that the new TOPCon solar technology uses 50% more silver than the old panels. What do you think the Chinese solar manufacturers are doing right now, 36 hours before their own government locks down the export market? They are vacuuming the domestic supply. They are the ones standing for delivery on the Shanghai Exchange. They are ensuring that while the rest of the world starves for silver, China will have enough to dominate the energy transition for the next decade. This is strategic resource capture disguised as a market rally. But the disconnect between the paper price and the real world isn't just happening in corporate boardrooms. It is happening on Main Street. It is happening at your local coin shop. It is happening on the major online bullion dealers. If you think the price of silver is $72.15, because that is what the ticker says on CNBC, try to buy an ounce of silver for $72. Go ahead. Try. You can't. We are seeing a complete decoupling of the street price from the spot price. Let's look at the premiums right now, because they are the only honest price signal left in the Western market. If you want to buy a US Silver Eagle, the standard government-issued bullion coin, you're not paying $72. The current premium on Silver Eagles has exploded to over $12 above spot. That puts the real price to acquire an Eagle at roughly $84. Does that number sound familiar? It should, because $84 is the exact price silver is trading at in Shanghai. Do you see the convergence? The paper price in New York says $72, but the real price in Shanghai is $84, and the real price at your local dealer is $84. The market has already repriced silver. The only entity that hasn't admitted it yet is the COMEX. The physical market, whether it is a factory in Shenzhen or a coin shop in Texas, has unanimously decided that silver is worth $84. The $12 premium isn't a surcharge. It is the difference between fantasy and reality. Let's look at the Canadian maples. Usually these trade at a $2 or $3 premium. Today, they are commanding a $10 premium. Even generic rounds, just basic lumps of silver with no collector value, are trading at $8 over spot. Usually, generics trade for 90 cents over spot. An $8 premium on generic silver is an 800% increase in the cost of physical acquisition. This is the market screaming at you. The dealers know they can't replace their inventory at $72. They know that if they sell you a coin today, they might have to pay $80 to get it back next week. So they are pricing in the future. They are pricing in the shortage. They are effectively telling you, the spot price is fake. If you want this metal, you pay the real price. And we are hearing reports that the supply chain behind the dealers is starting to freeze. The major wholesalers, the ones who supply the APMEX and the JM bullions of the world, are halting sales. They are pulling inventory off the website. You will see out of stock or alert me buttons appearing everywhere. Or worse, you will see pre-order, estimated shipping in 6 weeks. 6 weeks is code for we don't have it, and we hope we can find it before you sue us. When you see a 6-week delay in a market this volatile, it means the mints are backed up, the refiners are empty, and the system is gridlocked. So put it all together. You have Samsung buying 6 months of supply to keep their factories running. You have Tesla scrambling to secure critical inventory. You have the Chinese solar sector draining the Shanghai vaults. And you have the retail market charging a $12 premium just to let go of a single coin. This is a total rejection of the paper price. The entire world, from the billionaire CEO to the small-time stacker, is voting with their wallet. And their vote says silver is worth $84, not $72. The only people still trading at $72 are the high-frequency algorithms on the COMEX who don't have to take delivery. But as we saw in part 2, even they are starting to demand delivery. Even the paper traders are trying to cross the bridge into the physical world. But the bridge is burning. This industrial panic is the final nail in the coffin for the suppression scheme. You can manipulate a chart. You can manipulate sentiment, but you cannot manipulate a factory that needs silver to operate. When Samsung needs metal, they pay the price. Period. And when enough Samsungs start paying the real price, the COMEX breaks. The paper market becomes an empty shell, a museum exhibit of a failed pricing model. We are 36 hours away from the official start of the new world. But looking at these premiums, looking at these corporate panic buys, it is clear that the new world is already here. The price has already reset to $84. The paper market just hasn't updated the scoreboard yet. But on January 2nd, when the markets reopen and the export ban is law, the scoreboard is going to change, and it is going to change violently. In the final part of this broadcast, I'm going to walk you through exactly what happens in the next 36 hours. We have 12 hours left before the markets close for the holiday. Then we have 24 hours of darkness where the banking system will try to reset. And then, Thursday morning, I'm going to give you the SILVERGEDDON forecast. I'm going to tell you exactly where the price goes when the opening bell rings on a market with 0 Chinese exports and $12 premiums. The countdown is almost over. Let's look at the end game. We have exposed the $5.8 billion of emergency liquidity the Fed used to keep the banking system from collapsing this week. But now, we have to stop looking backward and start looking forward. We are staring at the most dangerous 36 hours in the history of the silver market. The clock is ticking down to Friday, January 2nd, 2026. This is the date the China export ban becomes active law. This is the date the supply chain officially locks down. But markets do not wait for the news, they front-run the news. So I'm going to walk you through exactly what is going to happen in the next 36 hours. I'm going to map out the event horizon, so you're not surprised when the chaos begins. We are entering phase 1, the last train. Right now, as I speak to you, we have less than 12 hours before the global markets shut down for the New Year's holiday. The Shanghai Futures Exchange closes in a few hours. The COMEX closes this afternoon. This is the final window of liquidity. This is the last chance for the paper shorts to cover their positions before the rules change. And this is the last chance for you to secure physical metal before the premiums explode again. If you're watching the screen tonight, do not be surprised if you see one last violent move. The banks might try to smash the price to $70 to trigger stops, or they might capitulate and send it to $75. But the price doesn't matter. The possession matters. Once the closing bell rings tonight, the doors are locked. The train leaves the station. If you're not on board with physical metal in your possession, you're left on the platform. Then we enter phase 2, the void. Tomorrow is Thursday, January 1st. The markets are closed, the screens are dark, the ticker is silent, but do not make the mistake of thinking nothing is happening. Thursday will be the most stressful day in the history of the bullion banking system. While the public celebrates the new year, the risk managers at JP Morgan, Citibank, and Goldman Sachs will be in emergency meetings. They will be looking at the 84-ton hole in the Shanghai vault. They will be looking at the 1,847 delivery notices they received today. And they will realize that when the sun comes up on Friday, they have to find 9 million ounces of silver that simply do not exist. Thursday is the day the industrial panic goes into overdrive. This is when the CEOs of Samsung and Tesla make the phone calls to the refiners. This is when the off-market deals happen. They will be bidding for metal in the dark, paying premiums that would make your head spin just to secure supply before the market reopens. We will not see these prices on a chart, but we will feel them on Friday. And finally, we arrive at phase 3, SILVERGEDDON, Friday morning, January 2nd. The opening bell rings. The China export ban is now active, the licenses are required, the borders are sealed, and the market realizes that the arbitrage is mathematically impossible. Here's my forecast for the opening seconds of trade on Friday. I believe we will see a gap up of historic proportions. The paper market in New York cannot open at $72 when the physical market in Shanghai is trading at $84 and the supply is cut off. The algorithm will try to close the gap instantly. We could see silver open at $78, then $80, then $82. It will try to teleport to the real price. But the price is not the danger. The danger is force majeure. Watch the news carefully on Friday morning. I believe we will start to see notices from smaller bullion dealers and perhaps even some industrial suppliers declaring force majeure. This is a legal term that means unforeseeable circumstances prevent us from fulfilling our contract. It is the polite way of saying we defaulted. They will tell their clients, we cannot deliver your silver because China changed the rules. They will offer to settle in cash. They will say, here's your $72 back. But the client doesn't want $72. The client wants the metal that is now worth $84. This is the moment the class action lawsuits begin. This is the moment the paper market loses all credibility. And watch the premium spread. If the spread is $12.40 today, do not be shocked if it hits $15 or $20 on Friday. Why? Because as the paper price tries to rise, the physical price will run away from it. Dealers will move to no offer. You will call to buy silver, and they will say, we have no inventory. Or they will say, the price is spot plus 20. The spot price will become a museum exhibit, a number that exists only on a computer screen in New York, completely detached from the reality of buying and selling actual metal. We are witnessing the final transfer of wealth. For 40 years, the wealth has been stolen from the physical holders by the paper shifters. They use leverage to suppress the price and keep the real value hidden. But in the next 36 hours, gravity takes over. China has removed the physical buffer. The Fed has exhausted the liquidity buffer, and the industrial buyers have exhausted the inventory buffer. There are no buffers left. There is only the naked truth of supply and demand. So, this is my final message to you before the new year. Do not look at the red candles and feel fear. Look at them and feel pity for the people who are selling real assets for paper currency that is being printed by the billions to cover a bank failure. You are on the right side of the trade. You are holding the asset that Samsung needs, that Tesla needs, and that China is hoarding. You are holding the asset that cannot be printed, cannot be hacked, and cannot be defaulted on. The era of paper silver ends tonight. The era of strategic silver begins on Friday. The 36-hour countdown is running. Hold fast, stay safe, and get ready for the repricing of a lifetime. This is John A.G. from Currency Archive. The warning is delivered. The timeline is set. I will see you on the other side of the gap. Like, subscribe, and share.